Right, so we'll start the session. Hello, everyone. My name is Vikas Agrawal, and I'm the founder of AltPort. It is your alternate port is a portfolio management services. So we are emerging as one of the largest platform for investing in alternates, and we've completed 5 years now. Some of you have been attending our webinars, might be familiar with the fact that we call this show as Ask the Expert Show, and the whole idea of organizing these knowledge-based session is to educate and empower the investment community about what's happening in alternate space. And I can see that a lot of interesting thing happening. And today I've invited a very special guest who is a good friend of mine. We know each other for many years now, and we have a common friend as well. So his name is Vivek. So Vivek, thank you so much for taking the time out and accepting a request and joining this call. Truly appreciate that.
Thanks, Vikas. My pleasure.
So let me have the privilege of introducing Vivek. So Vivek brings about almost 19 years of rich experience when it comes to investments, more particularly on both the credit side as well as equity side as well, in the sense that the overall capital market experience. And before, he's the managing partner at NB Capital. Before starting up this venture, he was part of a HDFC Bank and Yes Bank, where he was instrumental in terms of financing the entire entertainment industry in India, and played a very, very important role in terms of commercializing the whole thing. Because earlier it used to be, I would say, a very unorganized way of financing. And Vivek, has played a very important role in terms of organizing the whole thing as a platform, and doing a lot of great work in terms of helping investors to create wealth through this financing route. So today, idea is to read his mind and understand how this industry works. So as all of you know that private credit space is emerging as very, very important aspect in whole alternate investing game. And I'm glad to share that the total size of private credit has now surpassed more than 1 lakh crores for the first time. More particularly, it comes under CAT2 category. The CAT2 AIF is what we are referring to. And this is globally, when you look at private credit has become very large. And India is also following the same trend, in the sense that private, after the implication of the tax in mutual fund, more particularly in fixed income side, we've seen that HNIs and ultra HNIs investors are kind of moving towards exploring more opportunities in the CAT2 space, more particularly in private credit space. And private credit broadly has 2 or 3 different buckets. One is that, of course, this is unconventional way of financing the companies, but NB Capital is doing something different out of the box. They are financing a lot of projects on the entertainment side. So what we'll do is today we'll explore that. We'll understand why this value migration is happening, more from a fact only because of the taxation aspect, or HNIs are really finding it more interesting because they find it more promising. And we'll also try and understand what kind of risk which is involved here, because as I said, the private credit has 2 or 3 different buckets. Some of them are at about 12%, 12.5% kind of bucket, 13%. Some of them are at about 15, 16% of bucket, and some of them are at as high as 19, 20%. This is beyond the imagination. And they've also launched their gift city funds in this area, where NRI is getting 18, 19%, and dollar term 14, 15%. They are very happy about the whole private credit space here. So Vivek, it was a detailed introduction, but it was very important for me to set the context here from an investor point of view. Without any further ado, I would first hand it over the mic to you for you to be able to first explain your group and then share your experience, and then we'll come to Q&A. Over to you. Thank you.
Sure. Thanks a lot, Vikas, for the introduction, and happy to be here with this August group. As you rightly said, we are part of a private credit strategy as well. Okay, so private credit as a strategy has been booming over the last, I would say, 4-5 years, especially after COVID. And this asset class has been, quite instrumental in gaining access from a lot of investors globally. So under private credit, people do have various strategies. You have performing credit, you have real estate. Again, our asset class under media entertainment is one such strategy, which is slightly unconventional, so to say. But what we try to do is try to organize it to, the maximum possible so that, investors can invest in a much more informed manner in this particular space. What we endeavor to do is reduce the uncertainties and the risk involved in this entire process, which people don't understand this particular space quite well. We try to give access to them to the best of the projects. We try to give access to them to the best quality investee companies, and with a very high level detailed due diligence done from our side, so that, as I said, investors can invest in a much more informed manner. Things have changed in the last 7-8 years in the entertainment industry, especially post COVID. I'll just set a context of this entire conversation, then probably we can take it up from there. What has happened is, obviously, thanks to OTT and satellite, etc., which has been investing quite heavily in India over the last 7-8 years, the space has garnered a lot of interest, and from global players as well. So a movie which can generate X revenue till probably COVID, that X has become at least 4 to 5 times. Okay, so a 100 rupee movie which probably could generate up to 150 rupees of revenue up to 2020 or 2020 to 2019 or 20, that the potential of that movie to generate a 300 or a 350 crore or 350 rupees as compared to what it was probably 5-7 years back, has now become a reality. And that's thanks to the investments from the major global players, from OTT, music, and the satellite revenues, which has kicked in quite aggressively. So the uncertainties which was there in the industry, the uncertainties or the risk parameters which was prevalent over the last, I would say from early 2000 till 2018-19, has reduced quite substantially. The challenge is which project to identify. The challenge is where do one investor invest in, because there's every movie that is coming in every week, and every movie is quite attractive as far as the producer is concerned. And there is always, in every movie is like, every startup is like a 100x investment, like that. Every producer will always say my movie is a 100 crore movie. But that's from the producer's angle. What we do is we try and identify what is the best possible investment that an investor could do from all the projects that are available, from, as I said, trying to reduce the risk to the maximum extent, and invest from the fund in a manner which reduces the risk, and try to get a very high risk adjusted return, which we've been doing over the last 18 months from the fund. To give you a background of what we've been doing and why we've been doing this, so
Right. Maybe if you can just explain the structure first.
Yeah.
Through which, because there are some investors who are not familiar with the whole concept
Sure.
of CAT to private credit fund. So maybe we can start with that, and then maybe you can take us through how
Sure.
you're different from others.
So we are a SEBI registered category 2 category 2 fund. Our investment thesis or strategy is to invest as a debt instrument into the investee companies. So we do not take any sort of equity risk. It's a pure play debt fund that we invest in. Category 2 funds is nothing but like any bank or NBFC that they invest or they give loans to any company. Like, same way the fund would also invest in that particular company as an instrument. It can be an NCD instrument, or it can be an OCD. NCD is a non-convertible debenture. OCD is an optionally convertible debenture. So you can invest as one of these instruments into the investee company. So typically what a private credit fund does is the same thing that a bank or an NBFC would do. They would give loan or extend loans to companies. Similarly, all the private credit funds that are there in the market are in a way investing into these companies as an instrument from a debt perspective. So it's a pure play coupon bearing instrument. So you get a fixed coupon. So assuming the coupon is say a 15% or a 16% that I invest in, whatever I get back from the investee companies, that entire returns goes back to the investor. From a taxability perspective, I, as a fund, any private credit funds only withhold any CAT 2 private credit funds. Any CAT 2 funds withholds 10% as TDS, and the balance entire returns goes back to the investor. So as far as the investor is concerned, the taxability is at his end. The fund only withholds 10% TDS. So this is how the structure is. We come under the regulations of SEBI. We invest under the guidelines that is given by the SEBI on the broad guidance of what we can invest in. We invest in a very specific segment of media and entertainment because there is an opportunity which I will come to, as I said, what is the opportunity and why we are doing it. So if you see Cat 2, there are various kinds of funds. One is a private equity fund. One is a venture capital fund. These are all purely equity. Then you would have real estate funds. Again, real estate can be equity or can be debt. So in debt, again, they come under private credit category. Then if you move into more debt categories, you would have performing credit, then you have private credit. So we come under the private credit umbrella, which is basically under the Cat 2 ambit of funds.
Okay. So this is a SEBI approved structure for some of the investors who have just logged in here and trying to know for the first time. And at a pool level, then you have a different projects to whom you finance, right? We'll come to that first. My question is that do you also have some kind of fixed coupons to offer to these clients, and what is the duration generally you tend to have?
To the investors, you're saying?
Yeah. Suppose I join as an investor here. Yeah.
Correct. So any private credit fund would typically have anywhere between 4 to 6 years or much larger kind of tenures. These are mostly close-ended funds. These are not open-ended funds. So these are close-ended funds. So any investors investing would have to stay invested till the end of the fund, which is, as I said, the range could be anywhere starting from 4 years and go up to 6 years or 7 years. Our fund, the balance tenor of our fund is 5 years. So today, if any, less than 5 years. Today, if any investor is coming, he would have to stay invested till the end of the fund. There would be frequent payouts, interest payouts, as you say, income, dividend, whatever you want to say. So that payouts would happen annually to the investor, but the principal would be returned back to the fund at the end of the tenor of the fund. So it's a close-ended fund as per the regulations laid down by SEBI. And as you rightly said, there is pool of money that we collect, and that pool is invested across various projects. There are guidelines from SEBI that you cannot invest more than 25% of your pool in one particular industry. That's again breaking down trying to reduce the risk, investor risk in one particular company. So that's the broad guidelines that is laid down by SEBI and how much you can invest in a particular company. So, our strategy is much more conservative. We'll come to that. So these are broadly the guidelines that is laid down and how the investment has to be done.
Right. No, we are talking about that. So SEBI has recently approved this in the private credit space that you can finance these movies and some of the movies.
So the SEBI doesn't give any approval for investing or not investing in a space. This was a space that we always had our inclination and our experience in. We come with almost 17 years plus of experience of investing or financing this space. So we had applied to SEBI for investing or starting an AIF, an alternative investment fund, for investing in this space, primarily because the market is underpenetrated. There is an opportunity which we are trying to exploit, and the risk which was there, as I said, has come down to a very large extent as compared to earlier days. So which is why it's a virgin market as far as organized financing is concerned. So which is why the reason we basis our experience when we apply to SEBI, we have to show our experience, we have to show our past of where we have worked along with the credentials, etc., our investment experience. So all that has to be applied to SEBI. Basis that you get the approval from SEBI to start a fund of, and you have to broadly mention the strategy and the the sector in which you are going to invest in. So we had obviously taken the approval to invest in media and entertainment because that is where our expertise and our forte lie.
So Nitin, earlier in this space, banks and some of the NBFCs used to have major market shares. But how it is globally? What is your sense? How globally it is shaping up, and where are we headed as an economy in this area?
So this globally, Vikas, is a very big market. You have private equity funds and banks which are participating in a very large way globally. US being one of the biggest market for entertainment in terms of the size that they cater to. To give you some numbers, JP Morgan is one of of the largest banks which finance movies globally. They have an annual investment of approximately $10 billion. That's, slightly dated. It might be much more now. The last report that I read, it's $10 billion of annual investment that they have in entertainment sector, specifically movies. Apart from that, you have few private equity funds like Carlyle and some of the smaller funds which are there. Like there's a bonded media capital. There are funds which are there very prevalent in US because financing in the West is a very accepted and a common model, because banks or I would say these private equity funds are quite privy to investing in this particular space because the model is well set. It's a very old industry. All these OTT players, they've been there in US markets for a very long time. As far as India is concerned, the market over the last 6-7 years has been developing, and you would see more and more players coming into this space as we go forward, because of the the perceived risk which was there has reduced to a very large extent. So you would see more and more players coming in this space as well as we go. We obviously have the first mover advantage. We have that experience that we bring in, but I wouldn't be surprised if more and more players, in fact, we are aware of a couple of more players which are there in the market, and they've already taken license for investing in this space.
Can you also talk to us about your experience and Nitin's experience in this area? Because you've been, as I said, instrumental in terms of financing these lot of movies in India. So how was your experience, A? And also talk to us about, there is this perception among some investor community that if you finance some movies, then your money can go for toss, as in the risk level is very high. So maybe if you can throw some more lights, A, on your experience and how the industry is shaping up, and B, talk about the risk which is being involved.
Sure. So to go back to history, RBI had given banks permission to finance movies way back in 2002. They had come out with a circular wherein banks can participate in this particular industry and they can lend from their balance sheet. You had banks like IDBI and Exim Bank, which did start financing of this in this entertainment sector initially. So we, rather our ex organization Yes Bank, when we had joined, had slowly started this desk, and which Nitin had joined before me, and he was spearheading this division. So we started this financing of the space way back in 2008 onwards. So we had actually introduced the entire Bollywood producers or the production houses to bank financing. So none of these guys were earlier privy to bank financing. They were all privy to the old age fashion of unorganized financing, which, so to say, or private financing. One of the reasons also which we did is that digitization of theaters came in 2006. So earlier what used to happen is the movies were made in print. There was an analog form, and each print used to run across theaters. In 2006, the digitization concept came, and movies could be released across 2,000, 3,000 theaters, across India. So the spread of the movies became large. That's when we entered. So that's Bollywood. A lot of production houses in Bollywood were introduced to bank financing by us. Our experience has been very good in that space. So we, over the last, I would say till the time we were there in the bank, we had financed more than 50 movies in the bank. We didn't have a single instance of a NPA or a delinquency in our portfolio. We had managed that very well. One of the reasons was we had we used to carefully select the projects that we invest in. In this, the most important thing is of identification of cash flow, because ultimately this is entirely ring fenced by cash flow. You have to get the right cash flow. You have to escrow those cash flows against your investments. So we've done a very good job over the last, during our time, we were there for almost 14 years in the bank, when we had financed approximately 50 movies, and we had deployed in excess of 750 crores from the bank's balance sheet, of course, in this space. So that's the experience that we bring in. As I said, we've financed the entire Bollywood market. We have financed the South market, with the Telugu market or the Tamil market. We have introduced a lot of these players to bank financing, and we had a crystal clear book as far as the financing is concerned. Coming to perception, because see, This is a high risk industry. I'll make no mistake about it. It's about what stage you enter and how much to invest and with whom do you invest in. A lot of people's perception is coming or stemming from the fact that people have lost money because they have invested at a very early stage, or they have not done with the right people. People do get swayed away with the glamour part of it. So from that perspective, you tend to lose money. However, our model is very clear on three things. One is at what stage you entered. Second is against what you invest in. And third is how much you invest in. I think these three things are very important. If these three things are addressed, we have not seen a scenario wherein people have lost money, because we look at investing at top of the pyramid projects. So every year you have close to 1,800 movies which come every year in India across all languages.
Mhm.
Our endeavor is to invest in the top 100 movies. So the top 100 movies are the ones wherein again, within the top 100 movies, we are not going to invest in more than 25 to 30 movies. So we are looking at investing in only 25 to 30 movies annually, which is the top of the pyramid projects, wherein we know that if you invest in the manner which I told you, you will not lose money. So people who largely invest in, they are not able to get the right projects. People are not able to partner with the right production houses, which is one of the reasons that a lot of people lose money and are not able to they've not had a good experience in this space.
Okay, so essentially you're saying that you will like to diversify your portfolio with about 25-30 projects, bare minimum.
Yes.
It could be either movie or it could be OTT platform, whatever.
Yes.
I
Absolutely.
Okay. So when you said top 100, and these are rapid fire questions to you. So how do you get to know what? Because you are only looking at the input and not the output. That's an outcome of if the movie doesn't go well. For example, Roop
Correct.
Ki Rani and Choro Ko Raja was a movie which was made by Boni Kapoor. I remember, gone flop. So how would you kind of have control over that?
Sure. Very good question. So what has happened is, when people say the movie is not done well, that's at the theatrical level. Okay, so movies are hit or a flop in theaters. We do not take any sort of theatrical risk. We are a fund which only invests against non-theatrical rights. So be it an OTT right, be it a music right, or be it a satellite right, we do not invest against theatrical rights. Now, coming to your question about how do you assess? So typically, what is a target segment? We are looking at a target segment of 5 languages. So we look at Hindi and the 4 South languages, which is this is our market. We diversify our investment across all these languages. We are not looking at the other smaller markets as of now, like a Gujarati or a Punjabi or a Marathi as of now. So across these 5 languages, because every year there is approximately 600 movies that gets released, these 5 languages. Now, if I have to break this down as per the parameters, my investment parameters, what are the parameters? Let's do that. I do not invest in pre-seed. I do not invest in pre-production, which is the early stage of the movie. I invest only once the production starts. So in a typical land parlance, okay, if I have to put it in a real estate parlance, so land acquisition is a higher stage, right? So land acquisition, getting the license and putting fencing, getting up to the plinth level is a higher stage. That in a movie parlance is called pre-production. So we do not invest in pre-production because there are a lot of movies which have not crossed pre-production. There are a lot of movies which have failed when because of not people investing in pre-production, because the movie has not gone into floor also. So we do not invest in the pre-production stage. We invest once the movie goes into floor as far as the production is concerned. So again, same example, once plinth tak aa gaya, the floors are put, as far as the real estate, the slabs or the floors are put, we invest at that stage, which is more a cookie cutter model. So we are very clear, we do not invest as in an early stage, no pre-production. We invest only once the movie has started production. In that, we do with only the top production houses. So every market, these 5 markets, you would have 10 to 15 production houses who would be the top production houses which should be there, which should fall into our criteria, which have been doing movies regularly over the last 10-15 years, and annually they have at least 2 or 3 movies. Constant churn is there. So you have a market of 10 to 15 production houses in each of these 5 markets, which emerge as part of our investment criteria. So across these 5 markets, you have a pool of approximately 60 to 70 production houses, which is Hindi and the 4 South languages. These guys, every year they do at least 2 movies minimum. So you have a pool. That's how the pool has come down. As I told you, how do I identify this 100 to 150? So out of these 70 production houses, they move at least 2 movies a year minimum. So I have a pool of 140 movies or 150 movies across the top production houses, which come every year.
So how do you source a deal? You source a deal directly?
Sorry?
Directly.
Directly. This is all directly because of our experience, because we know the market. So the deals are all sourced directly. We know all the production houses, we know the promoters directly, all the producers directly. Now, once we enter, we do identify what our investment can be mapped against, whether it is going to be mapped against an OTT, or whether it is going to be mapped against a music right, or whether it's going to be mapped against a satellite right. Now, very important, why do we do this is because these values which we invest against are hard-coded, and they are sacrosanct irrespective of what the movie does in the theater or no. So when you say that the movie is a hit or a flop, that's at the theatrical level. These rights which we invest against, it doesn't affect the value of these. Their values if the movie is a hit or if the movie is a flop in the theater, or if it's a hit in the theater. These are sacrosanct. So, for example, if I invest here 10 crore in a movie, which I'm currently doing, and it has a satellite value of say 15 crores. So there is a platform which is buying the what satellite rights. Probably I'll just go slightly. So satellite rights is basically what you watch in your TV, or Z Cinema, Star Gold, Sony Max. These are all backed by channels like Sony, Z, Star. These are the platforms which are all ultimately large MNCs which are holding it. So that's satellite rights. I would invest against 10 crore against a 15 crore satellite right, which probably is being sold to a Sony. Now that movie would have done probably 10 crores or 20 crores in the theatrical level, but this 15 crores is not going to affect the the performance of the movie, and whatever I invest against these rights would be paid back to me, because these rights are in old parlance, it is mortgaged to me, and the receivables against these rights are escrowed to me. I have a proper control on the cash flows, and these cash flows or these revenues are escrowed, and it comes to my escrow account, against which post which my investment is paid off.
So you set up the escrow account essentially
Yes.
at the
Yes.
firm level, organization level, where you
Correct.
have and these rights are pledged to you.
Correct. So under the documentation, these rights are pledged to me. I open an escrow account, and all the revenues which come from these rights are coming to my escrow account, which is in my control. So
You be one of the authorized signatories.
Yes. So the bank doesn't act without my instruction.
So why would somebody take this kind of interest? I mean, I'm just asking, why would not go to banks where the difference in terms of, because you're not an equity guy,
True.
and the difference is as high as 4 to 5% if they take loan from the bank and they take it from you.
Very good question, Vikas. Before I answer about my industry, I'll give you a similar parlance of what's happening in the private credit market. Why are there so many? You mentioned at the start of a presentation that the private credit market is in excess of 1 lakh crore, correct? Why is that market booming? One of the reasons that it is booming is there is a space which banks and NBFCs don't fund. There is a lot of industries, a lot of sectors, a lot of I would say type of financing which banks cannot finance. Banks do not usually do large capex. Banks do not do a lot of acquisition financing. Banks do not do stress financing. So that's one of the reasons that a lot of private credit funds have emerged and have grown over the last so many years, who have been doing in the conventional industry. Similarly, in media entertainment, banks have an apprehension of funding because it's slightly unconventional. We in Yes Bank, we took a lot of time, first 2-3 years, to understand the space, and then we had expanded. Similarly, banks have enough in their plate as far as the conventional industry is concerned. And to add to that, a lot of banks, or I would say maximum banks these days, are more focused on retail. They are not focusing too much into corporate banking or corporate financing, which was there like earlier days. So, which is why, the lack of financing from banks or NBFCs, one of the reasons that, organized funding is not available, which is why we are able to get, the returns that we've been generating as on date. Having said that, even if banks start, doing it also in a very active or aggressive manner, there is still enough available in the market. As I said, we are looking at doing 25 to 30 movies. There is still a big pool which is available every year that one can look at financing. So it's not that the market will come down to, drastically as far as the interest rate is concerned. To draw an analogy on that, I'll give you, just real estate funds. Okay, 10 years back in 2000, when SEBI came out with the whole AIF, guideline and the space,
2012, yeah.
correct, in 2013, real estate funds, any new real estate fund that was coming, this is new to the market, right? Although there was real estate financing was prevalent, but real estate funds used to probably give higher returns because there were no active banks or NBFCs financing. Today, you have so much of competition in real estate funds that, the yields have come down because there is so much of competition. But that doesn't mean that, the space doesn't need more funds. You still have a lot of funds still coming in because there is demand. Similarly, in our space, the number of movies, it's a 100-year-old industry. If you see, the film industry is a 100-year-old industry and it's growing from strength to strength. Today, with active investments from large OTT players like Netflix, Amazon, Jio, Peacock Media, these guys have been investing heavily in India. So at a macro level, these people will continue to invest in India because simple reason, they're all plateaued as far as subscription base is concerned in the West. So in US and Europe, etc., their subscriber base is not going to increase beyond this. They're banned in China. So India is a big market for them. So they would continue to invest in India for content because India is able to give them diverse content at probably 1/4 of the cost or 1/5 of the cost what they would spend in the West. So, for example, one of the biggest series in India, which Netflix has invested in, would cost them around 200-250 crores. As compared to a big series, what they would have invested in US or UK would cost them around 1,500 crores. So see the gap that they are. So they are able to get much more content at a very low cost and good quality content also. So that's the reason you will have more and more players coming in. You will have more and more investments from these platforms, which typically would enable investors to participate in a much more informed manner, as I keep saying.
I'm just asking out of my curiosity, what would have been the reason that some of the large players have never thought about entering in this space? Because here the size of the industry, like for example, if you look at real estate, the total private equity put together in India is not even 20,000 crores. Visa requirement, which is more than 2 lakh crores in the real estate space.
True.
Clearly, I guess number would have been the same line as far as your industry is concerned. So what could have been the reason that some of the large asset management companies would have never thought about entering in this space?
So this industry has been, evolving. I wouldn't say it's, from early 2000 till now, till COVID time, it has just been growing in a very small manner. It's not that, it's gathered attention, and more importantly, it requires a bit of skill set. And that's very important because the skill set of identifying which, as I said, you need to know this 100-150 movies, because if you invest in that, you know that your money will not go. That is very clear. We have enough of data, enough of experience to validate that your money will not go if you are invested in these 100, 120 or 150 movies. If that skill set is achieved or people are able to identify that, then I think you would have more and more players. So it requires a bit of time. It requires a bit of experience, investment in people. So our team in our earlier organization, it's quite an experienced team which are joining us. We obviously bring that wealth of experience. So it's basically a little bit of skill that is required, and understanding and patience that is required in this space. It's because, as I said, it's slightly unconventional. It's an intangible asset class. You don't have any sort of tangible security. We invest against rights, which obviously ultimately these intangible rights has a lot of value. It's not that they don't have value. It's completely secured and it's a lot of value. But the understanding of that is which a lot of people don't, I would say, unfortunately have, and that's one of the reasons that you don't have a lot of organized players in this space.
Do you also demand some kind of collateral from the project, as in maybe some kind of net worth?
Yes. So all our investments, because is completely secured. Okay, all what I invest in is completely secured against the rights. I take personal guarantee of the promoters, and or I take the assets. Everything that I used to do in the bank or what an NBFC does, all that I take. It's not unsecured. And as I said, the cash flows are completely escrowed to me, and it's completely ring-fenced to me. I have complete control on the cash flows, because ultimately what takes you out or what gives you money is the cash flows. It's not the tangible security. Occasional cases I may have tangible security, but apart from that, maximum cases are all based on the intangible rights that I have, and I escrow it in my favor as far as the receivables are concerned.
What if one of the companies go belly up, as in they don't have anything to pay?
No. So good question. So how do we identify what is belly up in this case, right? So we've seen enough examples as to what can go wrong. Okay. So you start a movie, the movie cannot be completed is one of the examples wherein things cannot, wherein your investment can go absolutely bust. We take care of that by obviously investing with experienced guys in the top production houses. So if you go at production stage, we haven't seen a case wherein the movie has stopped. The movie gets completed with any of these production houses. You do with the first timer, yes, there is a risk. So which is one of the reasons we don't do with first timers. So we do with only the top 10, 15 guys, which is there in the market. So your production will not stop. Second, we invest against non-theatrical rights, as I said. So I have nothing to do with the theatrical. So I invest against a Netflix right or a Sony right against a satellite. The movie is a flop as far as the theater is concerned. So if it goes belly up also, the collections of the movie is what affects. These rights will continue. See, because I think the fundamental thing that you need to understand is and why it doesn't affect, because these are two separate rights, two separate ecosystems. The reason in that is separate viewership or separate subscribers that look into who are watching a OTT platform and people who go to theaters. Okay, a movie may be a hit in the theater and need not be a hit in the OTT platform. And similarly, a movie can be an absolute flop in the theater, but it can be a hit in the OTT ecosystem, because the viewership pattern or the viewer profile in both the ecosystems are different. So which is one of the reasons we do not invest against theater, because there is uncertainty and this chances of the investment going wrong or the movie going bust, etc. is there. We are looking at investing only against secured cash flows where there's certainty of cash flows. And in such cases we haven't seen that the investment would go absolutely wrong. So when you say it goes belly up, what would happen is the production is not completed, so it doesn't happen with the experienced guy. Or if the project gets stopped, if a project gets stopped for whatever reason, there is project insurance which is assigned to us. So that is also there. So there's insurance which is there. Every project is insured by all of these insurance companies with the 3-4 players which do it quite aggressively. So that is also assigned to us. So these are the checks and balances that we do before investment, and we make sure that these things are taken care of.
So do you consider insurance as one of the mandatory requirements for you to be able
Yes,
to finance?
it is there. Project insurance. So in fact, it's not only for me. Any production house, before they start the movie, they take insurance. Before that they won't go on the floor only, because it covers any sort of natural calamity. It covers the death of the actor or the leading star cast. So any producer will not go into the floor without taking insurance. That gets assigned to the investor who's in our favor whenever we are investing.
Can you also share some more lights on how the NPA levels are in this industry, and what kind of production houses that you prefer to get engaged with? Just some names, if I don't know if you're comfortable sharing.
Yeah. So I'll not be able to share the names, probably some in an open forum, but NPA levels is again because of lack of organized or institutional funding, there is no data to show if there's any NPA level. Obviously it's largely governed by private financiers and their books. So you have very large private financiers which have been doing down south, and some in west also, who have been investing quite heavily in this space. And they have been doing some of them have been doing for the last almost 20 years. Some have started post COVID because of various revenues that have kicked in post COVID. So they have an appetite for investing at pre-seed or a pre-production stage as well. So a couple of their investments, because they have started at an early stage, they have the appetite and they have the risk appetite to probably take because their own money is there. Apart from that, from institution side, we had a nil delinquency track record. So there has not been. The banks that have done, I would say a couple of NBFCs, I know L&T Finance used to do this when they had a corporate book. They also had a good book, and unfortunately they also became very retail and they had to shut down their corporate thing. So they also had a good experience in doing this. So again, if you've done it properly, you will not go wrong. What are the kind of projects or the production houses? Again, I'll go to that. Our theme remains investing on top of the line projects, because we will always look at those kind of projects. Some of the projects that we have done, from the fund, we have invested 8 projects, and we are going to do a couple of more in this quarter, are the cream projects wherein the saleability of these projects were already done. We've invested post that the returns have started coming. Our exits have happened. Out of these 8, we have already got exits in 5 of them. So our theme remains investing. Like, we've invested in a Rajnikant project. Okay, we've invested in a Dhanush project. Dhanush is one of the leading star cast in South. We invested in again a Tamil movie which had Tamanna Bhatia as a lead star cast, which is basically a franchise movie. So what we look at is, to answer the question, we look at franchise movies because we know that there's a history of the earlier franchise movies doing well. We look at prequel, sequel kind of movies where again the earlier movies have done well, and the top star cast, top directors, those kind of movies wherein we know that the saleability is not going to be a problem and the project will not get delayed beyond a point. So these are the kind of parameters that we look at before our choosing our investment.
Right. So one disclaimer here, that whatever names that Vivek is referring to is only for the educational purpose, that we are trying to decode the industry, the norms of the industry, trying to understand how it works, etc. So, and it is highly advisable that you not get into these things directly, and take the advice from the SEBI registered advisors. Okay, coming back to our question. So, very interesting space. So much to learn, Vivek, and you are in this industry for many years now, so
Sure.
you're familiar with a lot of things. Couple of more questions quickly. So when you say that you invest and you get exit, so what kind of typically the durations of these funds are, the investments are, A, and B, do you redeploy the funds after getting that, or because you have a tenure of 5 years or 7 years generally? Then I'm talking about the industry level. So
Sure.
as a fund house, do you prefer to redeploy, or how is it?
Yeah. So typically our investments average tenure is around 12 to 15 months. That's the cycle that we look at. And because from the time we start till the time the money comes back, this is broadly the timeline that we have and we have seen in all of our investments as well. And once the money is back, we redeploy the funds. So it is recycled back into newer investments. And the interest which we get is paid out to the investors. So we have a model of paying annual interest to the investors. So investors do get cash flows as far as the interest payment is concerned. The principal is recycled and it is reinvested back into the fund to new projects.
So generally at a fund level, you would have 5 to 7 years. 1 year can be extended. Is that correct?
5 plus 1 plus 1. Yes, that's
Ah.
this. But being the first fund, we do not intend to extend it. We will obviously be repaying it at the end of 5 years only.
Mhm.
Typically, we are looking at recycling the capital for another 2 times from here on, minimum.
Oh, okay. So you
So our
get sometimes short
recycling
duration.
is faster yes, 12 to 15 months. So our recycling ability as compared to other private credit funds are much faster because you have these faster churn of projects. In some other industries like a Malayalam industry, the projects are done within 6 months also, 6 to 9 months. There is very fast churning of these projects, which in some other industries. So we can recycle the capital much faster.
You also mentioned that you don't come in the foundation stage. Who comes at the foundation stage? Is it
So
the banks or NBFCs or their own money?
yeah, so this target segment that they have typically have their own money to do the foundation stage. They put in their own capital. So one of the criteria is that his skin in the game. So he puts in 15 to 20% of his own money as well to invest in that stage, which is basically signing the star cast, signing the director, doing the pre-production, designing the entire movie, scouting the locations, paying advance for flights, hotels, etc. That requires his own capital. So his skin in the game is also there. So his capital of at least 15 to 20% is invested at this point of time. And which is why it's important that you invest with these top 10, 15 guys, because they have capital to churn. They keep doing movies. So their returns from one capital is always invested into multiple projects. So the pre-production thing is taken care of.
And typically, what is the kind of size that you look at, and the total size, the overall size of the project? And within that, kind of, do you put some conditions that there has to be this much of skin in the game from the promoter,
It's
etc.?
15 to 20% is the skin in the game that we look at from the production house. That is a bare minimum. The investment size that we are looking at right now is, so we started with 10 crores. Now we are going closer to 20 crores as the investment size. We are looking at investing approximately 35 crores as our average ticket size of investments from the fund, which means the project should be somewhere around 70 to 75 crores. That's the project size that we are looking at. And that's broadly the range. Again, I'll give you an example. So even if I am doing 100 crore, like a Rajnikant project, which I invested in, it's in excess of 100 crore. But what I invest in, I don't need to invest 50% of that, right? I can invest against a specific right. So a 100 crore movie would have a sum of parts of revenue, say a 10 crore or 15 crore revenue against a satellite right or a digital right. I can invest against that. So my expertise or my skill set is to pick and choose these projects, curated projects, which is able to give me the returns and the safety of my investment. So not that I will participate in the entire project. I will participate in that right which is giving me comfort and which is not, which is basically meeting my criteria. That is what I look at. But to
And
answer
what
the
kind
question,
of
typically,
margins? Yeah, sorry, you were saying something. Please go.
the question typically I'm looking at around 35 crores as the investment size going forward.
Mhm. What is the typical kind of margins that you have in this industry, Vivek? Because for them to be able to serve this kind of debt at this kind of interest rate, I think is a challenge.
Not really, because so again, when you look at, you can't look at one movie. So each production house, as I said, these guys will be doing at least 2 to 3 movies a year. So each movie that he looks at is, one probably a 40 to 50% upside, one around 20%, and one probably a break even or probably a slight 5% or 10% loss. So if you average it out across the year for the production house for all these movies, he would be in the range of around 25 to 30% margin. That's the broad thing that he's going to look at.
Mhm. Do you see some of these players are getting more organized, planning to get their IPO listed in the
So you obviously have a lot of activity happening, especially after the whole Dharma Productions deal. I think
Big
almost
Poonawalla?
Adar Poonawalla has invested, the valuation was around 2,000 crores, and he's invested 1,000 crores into the company. So the long-term plan of the company is to obviously go public. So after that investment, you have a lot of activity which is happening across the production houses, wherein people want to get attract more investment from the investors and ultimately get into the public market space.
But do you see globally this trend is emerging in the sense that you have large production houses getting their companies listed in
So
the stock?
globally, a lot of these studios, almost all of them are listed. So that trend will come here also. You would have around 70 to 80% of the studios which are globally present are listed in the US stock market.
I'm just
So
thinking out that if suppose someone has to bury tomorrow and the project, and then these equity money can also come in to the private
true,
trade guys.
true. Ultimately, the whole point is that these guys have now started, since I would say since COVID, a lot of these production houses now started making money because of, thanks to OTT, thanks to the investment from the OTT in their projects and across their slate. So that's the best part of the investment or an investor can look at is investing in these industries now. If he was doing this probably pre-COVID, there was a risk element. Why the risk element? Just 2 minutes on that. Today, a movie can recover at least 75 to 80% from non-theatrical rights. So what's non-theatrical rights? Like Netflix, OTT rights, satellite right, music right, all this put together, he can recover at least 75 to 80% from non-theatrical. So the risk on the producer for theatrical, which is uncertain, right? A movie is a hit or flop only when people like it. That's around 20%. In South movies, because there is a Hindi dubbed right also, which is very big, people recover close to 100% of their cost, or at least 90% of the cost even before the release of the movie from non-theatrical rights, which wasn't the case earlier. When OTT wasn't there, your risk on theatrical was very high, which is why I'm saying that if somebody is looking at investment in this space, If you can map your investment against non-theatrical rights, any of the rights, it can be a satellite or music right or a OTT right, and you choose the right production house, your money will not go. It is about getting those right projects, right production house to ensure that, and you're completely, ring fenced as far as the investment is concerned.
So can you give us some perspective about what would be the number broadly pan India? You think that maybe I'm talking about those who have reached to a milestone and can come moving towards the organized space broadly in pan India level.
So this market that we are investing in, because okay, uh, every year, if I have to give you number of the investment that happens in this space in media entertainment, in films, investment that happens every year is around 18,000 crore. That's the investment that happens every year in movies. Now, if you look at the
Not even 5% of the total size, perhaps.
exactly, so that's the market opportunity. All these players, that the market that we have, top 10 production houses or 15 production houses in each market, that is, in Hindi and down south, so you have at least a 60 odd production companies. All of these are in the trajectory to probably over the next 5 years comfortably in a position to probably have access to public market or organized bank funding because of their balance sheet. There are newer players emerging also, which is coming in this bracket, because you have, players doing OTTs and now migrating to movies, getting that experience. Like, for example, one of the production houses called Love Ranjan. I mean, he was a very good production house, but a relatively smaller player till 2015-16. Today is one of the top 10 production houses in the country, right? Uh, Again, so that's what I'm saying. So you have smaller players also now coming in and moving into this bracket of top 15 production houses, and the pie is becoming bigger. So you would have people migrating, like having stronger balance sheets and getting access to external funding, whether it's an AIF or banks or probably some sort of equity funding over the next 5 years. This is the trajectory that we see.
Yeah. Vivek, having come from our industry side, you know this industry, how it works. So just asking out of my curiosity, do you have some agencies also who write some or analyze some writes reports on these
Absolutely.
production?
There is a research which we are working with. There is an agency research house called Ormax Media. They do very in-depth analysis about movies, about collections, what could be the first day collections, what could be the lifetime collection of the movie. They also do analysis of the potential of the movie in terms of hit or a flop, because they get into at the seed stage to find out. So they do behavioral pattern. They have a sample size wherein they do research with their audience. They've been working for the last almost 10-15 years. Ormax has been very prevalent. They have a lot of data as far as OTT is also concerned, the viewership data of OTT, how many people have watched which web series or which movie in an OTT. So there's a lot of data. There's the research house Ormax, which is doing that quite diligently, and we are working very closely with them.
But is there something like a Bloomberg where you get to see at a balance sheet level how many defaults have been done in the past or
No, that, unfortunately, they don't publish that. What they only do is they come out with their newsletter, what is publicly available. Apart from that, people who subscribe, it's made more to do with the PNL of the movie, and it's more to do with the viewership pattern and what people are changing towards. They also give insights into what is the new trends, what is the new genres that people like. So they are giving more about the industry, more about the patterns developing in the industry, the viewership patterns in all the ecosystem, whether it's OTT, satellite, or the theatrical ecosystem. They do not give this data that that you are mentioning about NPAs or
so how do you evaluate when you finance and do you look at companies in and out completely from a balance sheet point of
yes, yes, yes.
view,
We
from a
look at
habits of the promoter, whether the promoters are do they have a sort of intent to give the money back to
That's
let
the most important thing. I think, we coming from this space of financing and being part of this industry for the last almost 18 years, we know the ecosystem quite well. So I think what we look at, obviously, apart from the regular balance sheets and the movie, the movie credentials, the most important thing that we look at is the intent of the promoter, and that comes of primary importance for us, because we get that pulse and we try to get that pulse before we investing in.
And of course, you also evaluate the skin in the game, etc. So
Yeah,
that
yeah. As part of the, so one, obviously the credentials of the movie, the balance sheet strength, and obviously, as I said, the intent of the promoter. Even if the credentials of the movie is good and the cash flows, the intent of the promoter is not good, I will not enter. So the intent of the promoter is the most important thing that we look at, because we have seen in our experience that even if the movie, earlier days when there was no OTT, there was some sort of stress because of theatrical, the intent of the promoter was very good. He has paid us money even from his personal sources. So that becomes primary. So we come from a background of banking, so we understand credit very well. So we look at these things very carefully before we invest in.
Mhm. Do you also have some kind of ecosystem? Because you get to see that these promoters. I mean, of course, you look out for promoters who have reputation to lose, but some sort of suspicious activities goes around. Maybe somebody is going through depression or maybe not well, and you get to know from the other sources that look,
It's
be
well
careful.
networked. It's well networked because we have well entrenched networks in the industry to understand if there is any problem or anything. So that's we have kind of created that pretty well, I think, over the last so many years of being part in the ecosystem. So we know the auditors also of these promoters, this chartered accountants. We talk to them also. It's not just that the production company, the people associated with them also. We talk to the platforms. So before we enter, so we also talk to the platforms on their take of the movie, if they're going to say. The promoter is saying that he's talking to Netflix or he's talking to Sony or a Z. We talk to the platform to understand their pulse of the movie and what they're going to invest in and what is their take, etc. So we do an entire 360-degree approach. It's not just looking at a particular movie, which is why I said we bring that wealth of experience in this space, being part of this industry for the last 17, 18 years.
Yeah. And when you see the structure of these production houses, do you see it's more from a corporate getting into a corporate structure where you see that there is a good amount of ESOP is given to the people, or there is a more of promoter-driven approach where 100% of the equity belongs to one particular gentleman? He may be an actor of the movie or also a owner of the production house.
No, so as far as the movie P&L is concerned, there is obviously sharing with the star cast. It's not just the production, it's sharing with the star cast and sharing with the director. That's far as the movie P&L is concerned. So obviously, some of the actors do take profit share, some of the directors do take profit share. As far as the structure of the production house is concerned, uh, each production house has a CEO. Okay, and the CEO and the production house are partners as far as the shareholding is concerned. Unfortunately, ESOP as a culture has not yet come in this particular space. So employees have not got, but some of the CFOs are also part of the cap table in some of the companies, not a lot, but in some of the companies, the CFOs are also part of the cap table. Uh, One thing that is what we have seen is that all of these companies, or rather most of these companies, have moved from a proprietorship to an LLP. Some of them have moved from an LLP to a private limited company. There is a lot of governance. There is a more discipline. People have changed because, again, it's like they have started getting investments from OTTs, right, from the last 7, 8 years. So there is a lot of audit that happens from their end also. So it's not that it's just that their stat auditor is there. There are OTT guys also that keep coming there, keep looking into their books, seeing how they're doing things. So there is a lot of discipline, and there's a lot of I would say corporatization that has happened within the companies, and a lot of these companies have now ensured that they continue to do well, because there is these investments coming from these OTT platforms, which are obviously helping them in a very big way.
Okay, so which one is more important for you, the P&L of a project or a P&L of a company, or a combination of both, or either one of them is good, but maybe
Combination is important, because if a production company for the last 2 years is in complete losses for some of his projects, in terms of the theatrical, as all of his theatrical has gone down, we do not look at that, because then he'll find difficult to put in his own money also in his project. So we look at a combination of both, in terms of the project balance sheet and obviously the P&L of the project as well.
when you read these projects, do you see some more volatility in terms of success, or you see that some of the production houses are stable? So at a pedigree level, they are stable. because they are kind of capable enough to produce the right thing, and at a project level also they are, or you see a lot of volatility there?
There is, when you say volatility, what happens is that, one particular year is not the right best way to judge a particular production house, because he may have one or two movies which may be a flop as far as theatrical is concerned in that year, but he would have made money as far as the project is concerned because of the non-theatrical rights. So again, the next year the theatrical might be a hit. So it's, one particular year is not a right judge to look at it, but you have to look at it for the last 5 years as far as a company is concerned. As far as a project is concerned, we have, if the director or the actor, we have to look at his past 3-4 movies. That is also very important, because the, what is the collections that the director has given in the last 3-4 movies, what is the OTT values that the director has given for his movies, what is the OTT value of the actor that we are looking at, his past precedent movies. That becomes very important. So project level performance also, in terms of these parameters, become very important when we look at it.
All right, wonderful. Lot of questions and answers. So all these questions are from investor point of view, and
No, no,
they
absolutely. I'm happy to address more, because it's a new space. Ultimately, we are here to give comfort to people, because people are quite wary about investing in this space. As I said, our job is to ensure that we get the right project, curate the right investment for the investor. We have been doing so. What, if I have to give you some numbers, we have been delivering close to 20% net returns at the investor level for the last 2 years now. We have been communicating that we can deliver somewhere around 17 to 18%. That's a range that we are looking at. But having said that, currently we are delivering close to 20% net returns at the investor level. So the idea is to get those right projects and get those right, the risk adjusted returns, so that these parameters that we are talking about are well met, and we don't deviate from the overall strategy.
Right. So I would say that and start with a disclaimer again, that look, these are tentative returns. Obviously, it will keep changing. But what is more important is that, when you are having a single malt, Vivek, you expect kicker to take place. You expect that this kicker should come in. But when you have coffee, you don't expect any kind of kick to come in. And I can say that with kind of conversation that we had, and I know the background, we've done all due diligence, that our investors' money are in safe hand, at NB Capital, and you guys are doing a lot of due diligence, and this was the kind of question that I asked you. You answered all of them so patiently. That clearly indicates that the kind of capability that you and Nitin both bring on the table for our investors, and that is the most important thing.
Sure.
If I am having coffee, I don't expect anything go wrong with me. So if I am investing in fixed income, obviously I don't expect my capital to be lost, and therefore I was asking these difficult questions. So thank
No, no,
you giving me this answer so patiently. Thank you.
no, absolutely. That's our job is, as I said, to give comfort because of this asset class, and we are here to develop this asset class because we truly believe that there is an opportunity. The market is virgin. The idea is to pick and choose the right project. Pure, as I said, it's a pure play fixed income product. So we are looking at not looking at diversifying that into equity or anything of that sort. We know that this model will gain traction. You will have more people coming in. Idea is with whom you invest in, with the experience that we have, and that's the differentiating factor that we bring in. The whole point is who can bring you the best investments as far as this space is concerned, so that your money is safe and you're able to get a reasonable amount of returns on your investment as well.
All right. So with that, we'd like to conclude the session. Once again, truly appreciate all our investors to take the time out and giving us the patient hearing. If you have any more questions, please feel free to reach out to my team at allportfunds.com, and they would be able to answer the questions. Thank you.
Great. Thank you, Vikas.
Thanks. Bye.